Here's a question for the dual income couples watching. You and your partner each earn a great living. You have both been doing this for years. So why does the tax bill keep growing faster than your pay? This is one of the most common situations I see in Bay Area tech households and one of the least understood. Two engineers, or an engineer and a product lead, or any two people with real equity comp. They get married or they merge their finances and the math changes in a way nobody warned them about. The incomes add up the way you would expect. The taxes do not. Today I'm going to show you exactly why, how two incomes stack into higher brackets, why there is a real marriage penalty at the top, how a surtax called the net investment income tax quietly catches dual earners, and the mechanical reason your paycheck withholding is almost certainly too low, and then what to actually do about it. If you and your partner both earn well in tech, this one is for you. Let's get into it. Start with the single most important idea. Household income stacks. Your tax brackets do not reset just because there are two of you. When you file jointly, your two incomes get added together and taxed as one pile. The first dollars fill up the low brackets, and every dollar after that is taxed at a higher rate than the one before it. So here is the key consequence. Your partner's income does not get its own fresh set of low brackets. It lands on top of yours in the highest brackets your household reaches. A salary that felt like it was taxed at a moderate rate when that person was single is now being taxed at the margin at your combined top rate. This is why couples are so often shocked. Each person looks at their own salary and still thinks of it at the rate they paid as a single filer. But the household does not work that way. If one of you reaches the top federal bracket on your own, then effectively all of the other person's income is being taxed at that top rate. And then California stacks on top of that. I made the case in the piece on why the Bay Area high earners tax situation is different, that location alone pushes these households into territory most of the country never sees. Two incomes is that effect doubled. The combined number sets your rate, and the second income is the part that pays for it. Now, you may have heard that getting married is good for your taxes. For most American couples, that is actually true. Marriage is tax neutral, or even helpful, because Congress widened the lower brackets so that the joint brackets are simply double the single ones. At high incomes, that doubling breaks down. At the top of the schedule, the married filing jointly bracket is not twice the single bracket. Think about what that means. Two single high earners can each use the full run of lower brackets on their own returns. The moment they file jointly, that second set of lower brackets disappears, and more of the combined income gets taxed at the highest rate sooner. That is a real marriage penalty, and it only shows up at the income levels that are normal in Bay Area tech. And it compounds with everything else that phases out at high income. Deductions and credits that have income limits do not get more generous just because there are two earners. The same ceiling applies to a single filer and to a couple earning twice as much. So dual income households lose access to a whole list of breaks that lower earners keep. To be clear, this is not an argument to avoid getting married for tax reasons. It is just that two high-tech incomes filed jointly will almost always carry a higher effective rate than those two incomes would have carried apart. Plan for it instead of discovering it. Here is the cleanest example of the whole dual income problem. It is a surtax called the net investment income tax, and its threshold was never built for two earners. The net investment income tax adds an extra federal tax on your investment income. Capital gains, dividends, interest. It kicks in once your modified adjusted gross income passes a fixed threshold. And here's the trap. The threshold for a married couple is not double the single threshold. It is only modestly higher. So a single high earner might sit comfortably below the line while those exact same two people combined sail well past it. That has two consequences for tech couples. First, almost any investment income you have gets hit with this extra tax once you are over the line. That includes the gains from selling vested RSUs or from diversifying out of a concentrated position. So the work I covered on selling concentrated stock without a giant tax bill gets more important when this surtax is sitting on top of it, not less. Second, because the threshold does not rise with inflation, more of these households cross it every single year purely from raises in a rising market. Nothing about their behavior changed. The line just stayed still while their income grew. And the same fixed threshold problem applies to the additional Medicare tax on your wages, which starts at a comparable level and is also not doubled for couples. Between the two, a dual income tech household is paying surtaxes that the code's own threshold suggests were aimed at far fewer people than now pay them. Okay, so here's the mechanical reason the April bill keeps blindsiding people. Payroll withholding is calculated by each employer as if that paycheck were the household's only income. Your employer withholds based on your salary alone. It has no idea that your spouse also earns a high income. So it withholds as though your income starts down in the low brackets, when in reality, your household's combined income means your dollars are being taxed much higher up. And your partner's employer makes the exact same mistake on their end. So each paycheck is individually underwithheld relative to your true joint rate. And the gap is biggest precisely when both incomes are high. The same blind spot hits your supplemental income the hardest. RSUs and bonuses are often withheld at a flat federal supplemental rate that, for a dual income at the top, can be far below the rate those dollars will actually be taxed at. The shortfall builds quietly all year, and then it arrives as one number in April. Now, the fix is not complicated, but it does have to be deliberate. Run a real projection of your combined income and your true joint tax, then close the gap on purpose. You can adjust the withholding on your W-4s to account for the second income. You can make quarterly estimated payments to cover the shortfall, or both. The point is to replace the default assumption that each of you is a solo earner with the reality that you are one household sitting in the top brackets. The couples who do this stop getting surprised. The ones who do not just keep funding the surprise 1 year at a time. So here's the bottom line. Two tech incomes do not just add together. They stack into higher brackets. They trigger a real marriage penalty at the top. They push you past surtax thresholds that were never doubled for couples. And they break the withholding math built into every paycheck. None of that is a reason for alarm, and none of it happens by accident. You can plan around it. It is a reason to project your combined tax once, deliberately, and then adjust your withholding or your estimates to match the household you actually are. If you want to talk through your specific situation, the link to schedule a call is in the description. And if you haven't subscribed to Vested yet, my weekly newsletter for Bay Area tech professionals, the link for that is down there too. I'll see you next week.